blockchain and turn innovation into your competitive edge. Get started with the standard plan at $1,999, limited time $1,599, and unlock full curriculum access, a digital certificate, our community forum, and 3 months of instructor support. Build foundational expertise that gets you career entry-level ready faster and with confidence. Go further with premium at $2,999, limited time $2,399, including all standard features plus 6 months extended support, 2x one-on-one mentoring sessions, access to advanced workshops, and an alumni network invite. Enjoy accelerated learning, personalized guidance, and enhanced networking to stand out in the market. Scale with our corporate solutions featuring a tailored curriculum, dedicated corporate training, bulk enrollment discounts, and white label options. Equip teams with scalable training and give your organization a decisive strategic advantage. Enroll now and join a future-focused community mastering JFE Notary Chain from day one. Legacy paper diverges from physical reality. Eastern banks drain vaults while a Western closed loop traps premiums, around $97 and about $173 out. Family offices hold just 2% metals, institutional entry points to $8,000 gold and $230 silver with real security and physical possession. RESI 4.0 replaces ex-post litigation with ex-ante engineering. Proactive code-based self-executing contracts where breach is impossible. A civil law notary acts as a sovereign node certifying animus, so intent aligns with automated execution, the law between the parties. Compliance becomes syntax. Basel III and FATCA enforced as code with on-chain document notary seal and jurat hashes gated by RBAC. Be value-centric. Trade ratios to stack ounces, use goldbacks to bypass premiums, and never sell metal for dying currency. Run the ratio play and unlock liquidity via tokenized credit mining and non-recourse funding, while UTXO logic prevents double pledging and enforces awards instantly. Join the architecture of sovereign finance. Partner with Justice Fund and RESI 4.0 and verify the code today. Step into the future of trust architecture with Chapter 4, the Trust Guardian's Shield. Bidzal Bay faced the ultimate certainty. Mortality, but death was reimagined as a strategic liquidity event. The syntactical trust revolutionized bank-owned life insurance, integrating a fully autonomous management system. Tokenization transformed policy acquisition, creating an immutable audit trail secured by a quantum-resilient ledger. With AI-driven monitoring, health data triggered instant policy loans activated without human intervention. Liquidity reinvested in dynamic ventures from DRIPs to philanthropic EES strategies guided by AI insights. Upon death, a smart death trigger protocol autonomously distributed assets and satisfied tax obligations. In redefining mortality's role in financial planning, the trust perpetuated sovereign will across generations.
To keep a high-value physical asset completely secure, you have to lock it away. But the moment that heavy steel door swings shut, you kill the asset's immediate liquidity. The crypto industry attempts to solve this illiquidity by tokenizing real-world assets, aiming for instant, frictionless trading on the blockchain. But standard tokenization has a massive blind spot. If a borrower defaults, a digital token holds zero evidentiary weight in a physical courtroom. A judge cannot seize a cryptographic hash to make an investor whole. The Justice Fund Exchange, or JFE, is built specifically to bridge this gap. It operates as a highly gated, closed-loop network designed to turn finalized legal claims into liquid tokens that actually hold up in court. It runs on a doctrine called algorithmic jurisprudence. Traditional commercial law processes like perfection, notice, and execution are explicitly encoded into deterministic smart contract logic. Using the JFE requires a strict trade-off. Users must completely surrender the anonymous, permissionless access of typical decentralized finance, and in exchange, they receive absolute, ensured legal certainty. Because when a system faces extreme financial stress, cryptographic proof alone cannot protect collateral. Real-world commercial law enforcement is the only way to ensure digital assets survive a default. To actually generate yield from a secured physical asset, The JFE uses a specialized monetization layer known as the Aureum Custodia Finance, or ACF, protocol. At its center is the synthetic leaseback instrument. It separates physical ownership from economic utility. Custodium goldbacks are locked in a secure vault managed by the fiduciary, Affinet. Meanwhile, the economic utility circulates. The asset is leased, generating regular premiums for the owner. This clever structure solves the initial paradox. A heavy steel vault door can protect the physical gold, while the abstracted utility generates continuous liquid income on the blockchain. But this creates an obvious risk vector. Why should a smart contract assume a human lessee will actually keep paying their lease premiums? Standard decentralized lending relies on assumed borrower creditworthiness, a variable that frequently fails. The ACF protocol replaces that human variable with a master life insurance policy. To activate this coverage, a mathematical fiduciary trigger is met, legally naming the smart contract as the primary beneficiary. With the lease contract legally perfected on-chain and the insurance mathematically bound to the physical trust, the protocol can safely begin minting liquid yield tokens. This chart shows the strict conservative formula the system uses to mint capital. It caps liquid issuance at the lesser of two variables, either the verified insurance cover or 85% of the physical gold's real-time market value. By mathematically forcing digital issuance to stay below the hard real-world insurance guarantees, the system maintains a permanent fiduciary buffer. This entirely eliminates the systemic insolvency that repeatedly collapses unbacked crypto platforms. So what happens when the absolute worst-case scenario actually hits? The lessee stops paying and completely defaults on their premiums. If you hold a traditional paper-based legal claim, accessing that locked value takes months or even years of expensive courtroom litigation. The JFE handles this deterministically. To protect the investor's principal, the protocol executes a hard-coded settlement sequence known as the priority waterfall. Tier 1 is the frontline defense. The smart contract autonomously attempts to recover funds through standard lease premium income. If this fails, the system immediately moves down the waterfall. In Tier 2, the protocol completely bypasses the defaulting lessee. It initiates a cash value drawdown directly from the attached life insurance policy to cover the missed payments. If that cash value is somehow insufficient, Tier 3 triggers. The system routes a direct policy death benefit payout from the master facility down into the trust to make the investors whole. And finally, Tier 4. Only as a heavily governed, multi-signature last resort will the protocol ever liquidate the physically custodied goldbacks. By permanently reconciling perfected physical law with digital execution, the Justice Fund Exchange forces smart contracts to consume softer insurance layers before ever touching physical collateral. It executes financial maneuvers with the speed of decentralized finance, backed entirely by the uncompromising security of civil law.
Welcome, ladies and gentlemen, to Mining Newsflash. Today, featuring Canada Nickel, Arizona Sonoran Copper, Nucor Gold, Osisko Development, and Uranium Energy Corp. Here on Commodity TV. This video is distributed and paid for on behalf of Canada Nickel, Arizona Sonoran Copper, Nucor Gold, Osisko Development, and Uranium Energy Corp. Canada Nickel reached an important milestone for the Crawford project. Canada Nickel announced that the Canadian Impact Assessment Agency, IAAC, has officially started the federal environmental assessment for the Crawford Nickel project after confirming that the environmental study is complete. The final permit decision is targeted for summer 2026. Hudbay Minerals makes a major move with the acquisition of Arizona Sonoran Copper for around $1.5 billion. One of the most important copper projects in North America is being created. At the center is the Cactus project in Arizona, which will combine with Hudbay's existing Copper World project to form a major production hub. This deal comes at the right time as copper demand is stronger than ever, driven by electric vehicles, AI infrastructure, and the global race for critical metals. Hudbay not only gains full control of a key project, but also strengthens its future US production. In our opinion, all shareholders of Arizona Sonoran Copper should support this deal. This acquisition is more than just a transaction. It's a strategic step in the global competition for future metals, and Hudbay Minerals is now even better positioned. Nucor Gold enters the next growth phase. The drilling program at the NG Gold project in Ghana is expanded to a total of 60,000 meters with 3 drill rigs currently active. The goal is clear: to discover new gold resources and especially higher grade zones at depth. The project is already showing strong momentum. Gold resources have increased significantly and now exceed 2 million ounces, with further upside potential both at depth and across the whole property. At the same time, the pre-feasibility study is ongoing and expected to be completed by mid-2026. What does this mean? Nucor is accelerating its development and could move from an explorer to a serious gold producer soon. Osisko Development strengthens its cash position. Through the exercise of more than 5.6 million warrants, the company receives around 25 million Canadian dollars in fresh capital. The buyers include fund managed by Appian Capital, which is a strong signal of confidence from institutional investors. This capital supports the key project, the fully permitted Caribou Gold project in Canada. It is the core of Osisko's growth strategy and is expected to move the company into the ranks of mid-tier gold producers in total. In short, fresh capital and strong partners, Osisko is positioning itself for the next step toward gold production. Last but not least, Uranium Energy Corp sends a strong signal to the market. With more than $800 million in liquid assets and zero debt, the company is financially stronger than the most of its peers. At the same time, UEC is already generating revenue with around $20 million from uranium sales at attractive prices. Operationally, the company is also making progress. New production capacities in the United States are completed. Several projects are close to starting production, and the long-term goal is to build a fully integrated US uranium supply chain from mining to processing. Our conclusion: financially strong and strategically well-positioned, Uranium Energy is becoming a key player in the uranium market, even though profitability will take more time. If you enjoyed the video, please consider subscribing to the Commodity TV so you don't miss any updates from the world of mining and resource companies. You can also find all the information on our Commodity TV app, available in German and English, as well as comprehensive coverage of the global commodity sector. Please also note the disclaimer displayed. The discussed companies are or will be part of the SRC Mining Special Situation Certificate, and I am a shareholder of these companies. Thank you very much for watching us, and bye-bye from Switzerland.
In Focus with Jeremy Saffron is brought to you by Swan, the real Bitcoin company.
Welcome back. I'm Jeremy Saffron. Markets are dealing with a real monetary stress right now. We have roughly $10 trillion in U.S. government debt set to mature over the next year. Treasury yields remain elevated, and digital assets are being pulled deeper into the traditional institutional system through ETFs, stablecoins, and tokenized products. And at the same time, physical gold has been under extreme pressure this March, while Bitcoin has held steady in the low 70,000s despite war headlines and some pretty sharp volatility. Now, I say this because today is not just a conversation about Bitcoin's price. It's about whether money is becoming harder, more digital, or simply more controlled. So where is the real safe haven when debt, liquidity, and trust in the system are all being tested at once? Joining me to break this all down is Dr. Septin Amos, Austrian economist and author of the Bitcoin Standard, the Fiat Standard, and his newest book, The Gold Standard. Septin, it's great to have you on the show. Thanks for making the time.
Thank you for having me, Jeremy. It's a pleasure.
I want to start a little bit going backwards for a moment, because back in 2022, I mean, your framework was mostly built on, first principles, but we fast forward to 2026 and Bitcoin is much more institutional. It's more financialized, and it seems wrapped into the traditional system through ETFs, corporate treasury strategies, these stable coin rails. Has this new reality strengthened your thesis, or has it complicated it?
No, I think it's everything's going according to plan. If you were to ask me, I think probably if you asked me 5 years ago, I wouldn't have expected to have this much institutional adoption. I would have expected more individual adoption. Seems I was wrong about that. It seems that a lot of people just aren't going to get into it individually. They're going to get into it through institutions. But I think that's normal and predictable. And if you remember in the Bitcoin Standard, in my first book, I looked at the numbers for Bitcoin scaling, and I just said the demand for Bitcoin as hard money, as money that resists inflation, is far larger than the demand than the supply of Bitcoin block space. So it's going to be impossible for everybody to be able to get their own coffee transaction on chain for Bitcoin. But everybody's going to want to have a piece of the Bitcoin action. So inevitably, the majority of people are going to end up using second layer solutions in order to use Bitcoin. And one of these second layer solutions, in a sense, is institutional adoption. By buying an ETF, you're effectively getting exposure to Bitcoin without having to use it yourself. Of course, it has its drawdowns. I don't recommend it personally. I don't buy ETFs myself, but it works for some people, and I think it's going to continue to be the case. There's no use fighting it. It's a great financial asset that has beaten pretty much all financial assets over the last 10 years or so. Everybody's going to want a piece of the action.
I mean, if we kind of look at the actual math driving some of this right now, I mean, from an Austrian perspective, what does this $10 trillion debt refinancing wall suggest the Fed is likely to do, this year? And on the flip side, I mean, what would Jerome Powell have to do if if his real goal was to protect the dollar's credibility rather than just propping up the system's short-term stability?
Well, that's a very difficult question to answer. If he really wanted dollar stability, the answer is a lot more radical than what he studied in his grad school. I think if he really actually wanted dollar stability, he'd peg the dollar to something that wasn't a Ponzi scheme like the dollar, and he'd make it redeemable in it. So gold or Bitcoin are the only two choices as far as I'm concerned. And then that would limit inflation, and that would actually provide the credibility for the dollar. But if they don't do that, then, of course, they're not going to do that because of the political realities of democratic politics. People want the free lunch. People think they can get the free lunch, and they're going to always vote for the con artist who tells them they can have the free lunch. And the realities of just democratic politics are always going to mean that there will be inflation. So given that there is inflation, I wish them the best of luck, but there's no way to make a dollar stable while continuing with inflation. I mean, they can try all these fiat economics tricks of managing the price level, managing the money supply, but in the long run, all of these things lead to the destruction of the value of fiat money. It's all rearranging deck chairs on the Titanic. If you zoom out and look at the long term, the dollar loses 90% of its value every 20, 30 years or so. And there's no stopping that train. There's going to be more government spending. There's going to be more inflation. And it's only a matter of, politics is the matter of moving around winnings from this inflationary system to benefit some people at the expense of others. But I think the only radical solution ultimately is hard money, gold or Bitcoin.
Yeah, well said. I mean, we've had Judy Shelton on the show. Obviously, we've talked a little bit about what that could possibly look like. Would a gold peg, restore monetary discipline, or would it just expose how mispriced the dollar already is relative to real reserves?
No, it'll do both. I think, if you wanted to peg the dollar to gold, that would necessarily require a large revaluation of the dollar. You could say revaluation of gold, depending on how you look at it, but I think it's more accurate to say it's a revaluation of the dollar. You're going to have to basically, I mean, you can back the current dollar supply with the current gold supply at a much higher price of gold. I haven't run the numbers recently, but I presume it's going to be at least $10,000 an ounce of gold. At that kind of price levels, with the supposed gold reserves that the U.S. government supposedly has. Apparently, there's this crazy conspiracy theory that the U.S. government has 8,000 tons of gold. But, you know, I'm not a big fan of conspiracy theories, so I'm not so sure about it. I'd like to see an audit, but, you know, apparently audits are crazy.
Are hard to come by.
Conspiracy theory. Yeah. So presuming they have the gold, it's a very big if, then they could probably balance they could go into the hard money standard if they revalue the gold at a price that backs a sufficient amount of the dollars that they have issued, preferably all of the dollars, in order to have a proper gold standard. And if that were to happen, I mean, I think it's going to be a painful adjustment for the first few months. A lot of people are going to get wrecked in a certain way. There will be a massive monetary adjustment over a few months, but I think after that, we would get on a sound footing and the world economy would be a lot better. And of course, the politics would be very different because governments wouldn't be able to print money. They'd have to get taxation, and that makes politics a lot more complicated for them and a lot better for people.
Well said, Sabadine. I mean, you know, you look at today, and I'm kind of bringing this up in a more macro picture. We'll kind of get into more specifics, but I mean, we're watching global markets suffer extreme whiplash this week. I mean, we saw a brief rally on ceasefire hopes, but this morning Iran outright rejected the U.S. proposal, laid out a list of demands, and Brent crude has popped right back over $100 a barrel. I mean, for the average investor watching their portfolio whip around on these escalating geopolitical headlines, how do you practically distinguish between a violent geopolitical supply shock and actual fiat debasement?
Yeah, I mean, it's difficult to distinguish between the two because both of them are taking place at the same time.
Yeah.
So the dollar is always being devalued. I think that's just that's almost like the water in which we swim as fish. We don't even realize that we're in water because all we've ever experienced is water. So we're just normalized the idea that money loses its value. But yeah, the geopolitical shock can, of course, be real. And this one, I think, is very, very real. And I think the market reaction so far has probably, if you ask me by my opinion, has probably been understated compared to where I think things could go. But I mean, it seems initially, initially the reaction was, all right, the Iranian regime is going to be decapitated. They're not going to be able to do anything. This is going to be like Venezuela. It'll be over in 3-4 days. That didn't work out. Then there was the idea that, well, they're not going to be able to close Hormuz. Their military capacity is done. Turns out that they managed to close it. And after 2-3 weeks of government propaganda and media lies and just absolutely hilarious cope and seething by the administration about it, well, you know, the strait is open. It's just that Iran might shoot you if you go there, but we recommend that you go there and try. We're not going to send the Navy, obviously, because we don't want them to get shot. But, you know, all these commercial tankers should go, and all these other countries should send their Navy. Well, then it became clear, you know, after all of the delusions and lies died down, it became clear, no, the Hormuz is actually closed, and they have an iron grip on it. So that looked like it was a problem. I think now things are being resolved as we speak right now, or I would say the price is probably nowhere near as high as it could be, because it seems clear that a lot of boats are leaving the Straits of Hormuz because they have struck a deal with the Iranian regime. So the Iranian regime has effectively installed a toll booth on the Strait of Hormuz, which seems to be charging about 1% of the market value of the oil on tankers based on early estimates that we've seen. So if this sticks and if this continues, I mean, it's going to cause very little disruption in the long term because it's just a 1% tax. Obviously, there's been a lot of disruption over the past few weeks because of the destruction of infrastructure. So that's going to likely affect the markets for a while. And, you know, the conflict is not really over. But if the Iranians succeed in imposing this toll booth, then likely the oil market normalizes. Prices will remain high for a while, but it'll likely be normalized over time. But it's a big question if they can keep it up. I mean, I think militarily they have a very good case because they have all these distributed drones all over, and they just need to hit one tanker a week to scare away, well, maybe one tanker a month scare away all the other tankers. And it's a very, very, very complicated military operation for the US to try and stop all of these drones. Likely, I would think probably it would require the largest military deployment by the US since World War II to try and conquer Iran completely, comb all of the coastline, clear it from drones and missiles, and make it safe enough that commercial tankers can cross without paying the Iranian toll. It's not an easy thing. It's an extremely difficult thing to see. So it's difficult to tell. And I would say, I mean, I follow this because I happen to live in the region. The rockets are flying over my house and the sirens are bursting out several times every day. So, of course, I'm very into following what's going on. But I think financially, I'm generally not a fan of trading the news. I'm not a fan of sitting at watching TV, reading the internet, and then managing your portfolio actively based on that stuff. And of course, if you're in the fiat markets, you have to do that because the fiat markets are all about the news and it's all manipulated and it's all about what the Federal Reserve says and does. So you have no choice but to basically be a part-time hedge fund manager, no matter what you do. You need to pay attention to all of these things that are going on. But that's why I like being in Bitcoin.
Yeah.
Bitcoin is completely immune to all of this bullshit. You just buy Bitcoin, you wait 5 years, and you look back 5 years later, and all of this stuff is noise. You know, I remember, for instance, when the Russian-Ukrainian war started, and it was 4 years ago, and there was so much discussion about what Bitcoin is going to do and how is Bitcoin going to react, and is it going to go up or is it going to go down? And you know, depending on the time frame, if you looked at the first day, it crashed. Then the first week, it went up. Then the first month, it went down, or something like that. I don't remember the exact specifics. But there was a huge debate about, well, it's going to rise, it's going to go down. Doesn't matter. Ultimately, what was the effect of the Russian-Ukrainian war on Bitcoin? I don't know. What was the effect of this Iranian-Israeli-US war on Bitcoin? I have no idea. I think in the long run, Bitcoin just marches to its own drumbeat. I think it's still too small to be a macro asset that is affected by macro movements. I still think the dynamics of Bitcoin supply and the psychology of Bitcoin holders, particularly the old-time holders who held it for a long time, I think these are probably far more effective to price determination in the Bitcoin market than geopolitical events.
Yeah, that's interesting because we're going to kind of pivot there. I mean, how these assets actually behave under stress. I mean, you know, you talked about 4-year cycle with me kind of coming before coming on air. And I wanted to ask you, because I mean, if Bitcoin still trades a little bit with macro risk sentiment during these geopolitical shocks, like we saw maybe this week, why should gold investors treat it as a true safe haven right now?
Well, I mean, it's difficult to tell with gold. I used to be a big gold bug before I got into Bitcoin. I was a massive gold bug. I rode the gold bubble in around I think it was 2008 to 2011, and then there was a big crash after that, and that crash forced me to reconsider and revise my assumptions about what was going on, and that's how I discovered Bitcoin and I opened my mind up to Bitcoin and became a Bitcoiner. So it's a difficult question for me to ascertain what's happening with gold. I would say, you know, the recent run in gold caught me by surprise. I did not expect it to be this quick and this this vast, this big of a rise. And it's I guess for me, the question is what happens next. My honest opinion, I can't feel comfortable recommending that people hold gold for the long term, because I think you look at 2011, the price went from 1,900, crashed down, only recovered, I think, in 2020 or something like that, maybe 21. So, there's a 9-10 year bear market in gold that you have to sit through if you buy at a very high rate. And then in 1980, in the year and I was born, the gold price hit 800 and then it crashed and only got back to 800 in 2008. So that's 28 year bear market. That's the whole generation. So I don't feel comfortable telling people to buy gold anymore as I used to when I was a gold bug. I think ultimately the fact that governments control gold clearance, the fact that they don't allow the creation of gold banks, is almost a fatal hit to gold's monetary role. It's just, as long as you can't have a bank account in gold and you can't just send gold directly, you can't use it to settle payments, you can't run your accounts with gold because you have to run it with your local national currency. then gold's monetary role is always going to be limited. People are going to buy into it and out of it, and they're going to incur significant transaction fees every time they do that. And that will likely just undermine the saleability, because ultimately what money is, the most important property of money is its saleability. So if people aren't able to accept it as payment, if people aren't able to trade it with one another directly, that's going to massively undermine its saleability. And it looks like, for me, that's why gold didn't recover from the bull market in 1980. I think this is the difference with Bitcoin. Bitcoin is just, in a sense, a more advanced monetary technology because it has the halving. So in 1980, when gold hit $800 or something like that, it crashed down. Now imagine if in 1982, annual production of gold dropped by half. The bull market in gold would have returned a lot quicker. But instead, in physical gold, in 1982, probably that was the time when production was ramping up because of all of the investment that was made into gold mining in 1977, 8, 9, and 80 during the big bubble. So people overinvest in mining, and then that results in a lot more production coming on at the time when the bubble bursts. And that's why the thing can stay dead for a significant amount of time. So with the difficulty adjustment, with the halving, Bitcoin fixes that because it ends up making sure that the supply drops every 4 years. So even if the demand doesn't go up, the fact that the marginal supply declines causes an increase in the price.
Right. So, I mean, if gold can still store value but cannot move freely or settle kind of globally or, escape those custody checkpoints, then you're really saying Bitcoin is not replacing gold's theory, but solving, I guess, the political weakness of gold.
Exactly. So if you were to ask me, all right, so what do you do about gold? How do you use it? Well, I don't know. I mean, if you can shut down your local central bank or force them to take gold, then by all means, go ahead. But the only practical solution we have, the only accessible solution, the only realistic solution for the problems of gold is Bitcoin. It's something that recreates the monetary properties of gold, but makes it digital and then improves upon it by introducing the halving, by introducing the difficulty adjustment, which ensures that we're always going to get a declining supply growth rate, and that more mining cannot result in more production taking place. That, for me, is the case for Bitcoin. Bitcoin is the gold that is built to defeat governments, and that's a flaw that physical gold doesn't have. Unfortunately, governments have managed to kill it.
Here's a question for you. As a former gold bug, I'm sure that you've been paying attention a little bit to COMEX, the price discovery, this paper market. I mean, when we look at the current mechanics of the paper gold markets, do they actually help liquidity and price discovery, or do they weaken gold's function as a monetary signal by creating, leverage that can just swamp the physical market?
That's a great question. I don't quite have strong opinions on this question. I think, initially when I used to be a gold bug, I was very much on board with this idea that these futures markets are being manipulated, and that's how the fiat system survives, because naturally everybody wants to buy gold. If everybody buys gold, there's no way of printing more gold. The price of gold goes up. Eventually gold dominates cash balances. The fact that it's not doing it suggests that there's some manipulation going on. And, gold bugs have spoken about this for many, many years. As time has gone by, I have less confidence in the hypothesis. I would say the reason that gold doesn't go up might not necessarily be the paper market manipulation. It's the fact that it can't trade, that you can't use gold for direct payment. And so therefore you're always switching in and out of it, and therefore you're always incurring transaction fees, which is essentially undermining the role of gold. So, since if that were really the problem, then it might be the case that the futures market is not really the guilty party that is causing the problems of gold and preventing gold from monetizing. But it could be, it could also be seen as another way of looking at this is that, within these futures market, ultimately, the only way that you're able to essentially manipulate the price is if there's some kind of monopolization of the movement of physical gold. And this is what we have with gold, because there is no easy, large, clearly transparent, liquid market for people to be selling and buying physical gold in the same way that the LBMA is supposed to function, but it functions in a very opaque way. So if we had 100 LBMAs all over the world where people are able to get physical gold for their paper almost seamlessly, then it would be a lot harder for shenanigans in the futures market to affect the price, because ultimately there's a day in which you need to deliver physical, and you can only screw around with paper so long before you get called out with a physical. But if you run the rails on which the physical settles, and if you have a monopoly on these rails, if you have a monopoly on the banking system, and if you have a banking license that allows you effectively to print money, well, then that can allow you to rig the game, and that can really change how the entire game is played. So I think this for me ultimately is another flaw of gold that Bitcoin fixes, which is that by being digitally native, Bitcoin allows for the large liquid market for people to settle with one another directly in Bitcoin to be huge and liquid and available 24/7 all over the world, which makes futures markets shenanigans a lot more difficult.
Yeah. I mean, do you believe that the U.S. gold is fully there, fully kind of accessible, truly usable for modern monetary reset? Or do you think Fort Knox is kind of more as a symbol than a credible monetary backstop?
I mean, fortunately, I don't have to answer that question because I'm in no position to be answering. I don't know. I wasn't the one who put it there, and I don't have access to the keys. So I have no idea. But, if you ask me to bet, I'd say it's not there. I mean, saying we can't have an audit is just an admission of theft, essentially. So something fishy is going on. And of course, the way that Elon Musk was just completely lobotomized about this topic, and it was almost like, they removed the software from his brain, and then he was never allowed to talk about it ever again after he brought it up, doesn't inspire a lot of confidence. That's not what people who have 8,000 tons of gold would be doing. If they actually had the 8,000 tons of gold, they'd have tours open for Americans to go and see the 8,000 tons of gold. I mean, it's an enormous sum of gold. America should be very proud of it. They should have it on display. They should have it in several different vaults across the country, and people come and see it, and people should be able to redeem it. The fact that they don't, I think, speaks volumes. But what do I know?
I hear you. We'll continue to ask all of our guests. Okay, well, let's move on to kind of miners, margins, a little bit on Wall Street, because, the economic stress inside the Bitcoin mining industry is interesting. We saw reports in mid-March estimating average production costs near $88,000 per Bitcoin, while the spot price was sitting in the low 70s. How does this network sustain itself economically when a large part of the mining base is underwater at the current prices?
Oh, it doesn't matter. It's a problem for the miners. The network will continue. In a sense, you can think about it in gold terms. There's gold that's being circulated and used monetarily. And if an earthquake happens that harms one of the miners and puts one of the miners out of business, that's just going to mean that a little bit less new gold is going to come on the market. But it's not going to affect the function of gold as a money that is being used every day in coins and bars. With Bitcoin, it's even less, because with Bitcoin, the new supply that is going to come on will be the same, regardless of what happens to the miners. So if we have $10 billion of capital mining Bitcoin, or if we have $10 of capital mining Bitcoin, we're only going to be getting, I think it is, what are we now, 450? No, I think we dropped by half, 225 new coins a day. Or maybe it's 450, I forget. Anyways, but we'll be getting the fixed number of Bitcoin every day, and regardless of what happens with the mining industry. Now, generally, you look at Bitcoin cycles, this is generally the time where Bitcoin miners start hurting a lot, because a lot of miners get overexcited and they start overinvesting during the bull market when Bitcoin's price is going up. And at that point, the price is going up, and mining Bitcoin looks like a no-brainer, and it seems like it's a great idea. You have great margins. But then, of course, the key thing with Bitcoin is the difficulty adjustment. The difficulty of mining goes up, so the cost of mining Bitcoin goes up. And generally, it's always going up to catch up with the price of Bitcoin, and then it declines roughly if the price of Bitcoin declines. So After they've overinvested in the bull market, then there comes the crash, which we had the top in October. It's been 5 months now. We've crashed, and I think we may be getting a few more months of sideways or downward action, which is going to be very stressful for the miners because they invested. The ones that were investing during the bull market, they bought their equipment at high premiums because the equipment was in high demand at that time. And at that point, the difficulty was relatively low. Price goes up, difficulty goes up, more and more capital comes along, more and more investment comes along. So this is the point of maximum pain. We're coming up to the maximum pain point for miners, which is price is declining, difficulty is still going up because a lot of miners are still coming online because of the investments they made in the bull market. Right. So this becomes the most brutal time for Bitcoin miners. And I generally just think, as with gold, I have a very strong opinion on the idea that you should just stay out of Bitcoin mining and gold mining. I think, if you have some kind of technical understanding of the industry, if you have some advantage that allows you access to, say, very cheap energy, then maybe you should consider mining Bitcoin. If you have some engineering or capital advantage that allows you to mine gold, then maybe you should get into it. But that, I think, misses the point. In other words, maybe the mining part of gold or Bitcoin is by design supposed to be trifling, insignificant. And the real use case is the money. It's the trading. That's, in fact, as I explained in the Bitcoin Standard, the whole reason that gold becomes money, and by extension, the whole reason why I think Bitcoin becomes money, is precisely because mining is inconsequential, it's small, and it's unprofitable usually, and it doesn't grow. If mining was profitable, if mining gold and Bitcoin was usually profitable, then we'd have inflation and it would suck as money. But it's designed to be a zero-sum game with Bitcoin, and it's close to a zero-sum game in gold because it's very difficult to find gold. And then the more that you invest, the more expensive it becomes. And then it becomes difficult to find significant enough margins. So my advice is money is made for spending and holding, not for mining. Mining is it's supposed to be an unprofitable business for those monies to work very well. And I think if you follow the gold industry, gold miners have been complaining, and people who invest in gold miners have basically been complaining about it forever. Gold mining has underperformed Bitcoin. Gold mining has underperformed gold. And I think Bitcoin mining has likely underperformed Bitcoin. I ran a poll on my Twitter once where something like 5,000 people answered. And the question was, if you've mined Bitcoin for more than 5 years and calculated all the expenses that you incurred, would you have been better off just putting all of the expenses into buying Bitcoin instead of going through the mining? And something like 78% said yes, they would have been better off just buying Bitcoin. So you're getting into a massive headache and introducing all kinds of risks. And there's a 78% chance that it's going to give you fewer Satoshis than you would have had otherwise. And I would probably say it's actually likely higher than 78%, because I think people are not very good at calculating opportunity cost and calculating all the costs that they've incurred. So probably among those 22% who think they outperformed holding, I think if you count all the costs, particularly the time invested in mining, I think a lot of them would realize they would have been better off just holding Bitcoin. So yeah, hold, don't mine.
Yeah, hold, don't mine. I mean, your thesis since the beginning has been somewhat of the same. I mean, on this, I guess we could kind of talk about the sovereigns too, because you frequently advise on building digital treasuries. But we're tracking reports this year that Bhutan has been actively selling off portions of its Bitcoin holdings. Are more sovereign states looking to build these reserves? And what are you seeing here?
Yeah, Bhutan, I have no particular insight into what they're doing, but they seem to have made a ton of Bitcoin out of mining. They have a lot of stranded energy there. They've invested in mining Bitcoin over several years. They've accumulated a significant stash. And I mean, it was an investment. So yeah, you need to liquidate the investment. They have salaries to pay. But they've accumulated this very significant sum. I mean, Bhutan is a very small country and it's not very rich. So they've accumulated, I think, more than $1 billion worth of Bitcoin at a certain point. I don't know what it is now and how much they've sold, and with the price going down, it's probably declined. But that's a lot of money because the entire GDP of the country is a tiny number. So this is a significant chunk of their GDP. Obviously, you shouldn't compare flows and stocks, but it's still quite instructive. And other than that, I mean, El Salvador is still stacking Bitcoin. They just keep buying. They don't care. And they've been doing it for 5 years, and it's netted them hundreds of millions of dollars worth of profit. And I expect them to continue to do that. Now, other than that, I don't really have much particular insight into nation-state adoption. I know Abu Dhabi, one of the sovereign wealth funds in Abu Dhabi, had been mining Bitcoin for a while, and they did really well with that, and it's becoming more and more popular. We had all of the Trump circus about using a strategic Bitcoin reserve, but then he ended up buying pesos to bail out Milei and launched his own shitcoin. So glad I never got my hopes up on that one.
It's a fair point. I mean, Bhutan is effectively monetized part of its Bitcoin position when they needed it. I mean, but does that prove Bitcoin kind of worked as a treasury asset, or does it prove that even sovereign holders still treat it as something to sell into fiat when real world obligations hit them?
Yeah, I mean, everything is, money is made to be spent. So this notion that you just stack Bitcoin forever, I mean, it's, I think there's mimetic value in it, and it's good to drive the point home, particularly to new Bitcoiners, to just explain that, you're missing the point if you're just buying Bitcoin from Coinbase and then spending it the next day on your coffee and pizza and then having to buy Coinbase again. You're just paying extra fees to Coinbase and then paying extra fees at the terminal and just wasting your time, and you're not benefiting from what actually Bitcoin allows you, which is protecting yourself from inflation.
I mean, we could go into it more. It's mostly about, if central banks are ever going to start seeing Bitcoin as kind of a strategic reserve, much like they look at gold, right?
Yeah. So I was saying, so you should, but in reality, I mean, everybody needs to spend their money, so it's not there to be held. And when you make an investment into mining, or when you make an investment into buying Bitcoin, you've foregone spending. So you could have bought a new car, but you decide, all right, I'm not going to buy a new car. I'm going to stay with my old car so that I can buy Bitcoin. And then in 3 years' time, I'll revisit. Well, 3 years later, your Bitcoin's appreciated significantly. So now what do? Well, now your old car is a lot older. So you still need to buy. That's okay. You're going to have to sell some of your Bitcoin at some point, and that's fine. So I think that also applies for governments. The Bhutan government invested significant amounts of capital in order to make this happen. And if they can't get increased spending out of this, then how useful are just reserves that you're never going to be using? It's useful to be able to use them. So, I don't know what they're doing, but I would hope that they understand the long-term value proposition and accumulate some of the Bitcoin. But of course, I understand that they're going to have to spend some of it.
Yeah, I'm glad that you said that. I mean, a lot of people, they just kind of see these drawdowns. But I mean, that 4 or 5 year kind of cycle, as you talked about, is important to understand. I wanted to ask you about stable coins too. I mean, they're some of the largest buyers of short-term U.S. paper in the digital asset system right now. So are they really undermining fiat, or are they just kind of extending the dollar's dominance through, these new digital rails?
Yeah, it's a good question. I think the obvious answer is they are extending it because they're allowing more and more people around the world to buy more dollars, and then they are buying treasuries. So essentially, they are buying the U.S. government's bags. They're bailing out the U.S. government. They are essentially a holder of last resort, in a sense, because they are currently one of the biggest buyers of treasuries in the world. They're buying more than most central banks. So in a sense, it is increasing demand for treasuries. However, I would make the counterpoint. I'd say there's significant evidence to the contrary. Number one, a lot of this new demand for USDT and stablecoins is derived from the fact that, I should say it's displacing existing dollar demand. So when somebody in Turkey decides to stop using their bank account for trading and starts using USDT, well, their bank account, you may have been either in Turkish liras or in US dollars, whichever one, there's going to be backing it US dollars and treasuries. So when you dump your Turkish lira bank account or US dollar bank account in Turkey and you start using USDT instead, that's not all new demand for dollars and USDT and US treasuries. That's displacing some demand. that has already existed. And I think if you run the numbers on it, I think even with the most optimistic scenario for the growth of Tether, I don't see it making a dent in the fiscal situation in the US. And I gave a talk in the Bitcoin conference last year about this topic. And that was before the war in Iran. But even just assuming that we went on with the same kind of projections of how spending was going over the past 10 years, projected into the next 10 years, and you see that the budgets are just going to grow enormously. The debt is going to grow enormously. And whatever little amount of purchases that USDTs are going to produce is not going to make a big difference in the grand scheme of things. However, where it will make a big difference in the grand scheme of things is with the small fraction of their profits that they use to buy Bitcoin. Because even though it's a lot less than the treasuries that they buy, it's a lot bigger as a percentage of the Bitcoin total market capitalization. And so even if, of course, they're going to be buying more treasuries because they're offering a treasury stablecoin, they're not offering a Bitcoin stablecoin. So they have no business use for buying Bitcoin for their operations. They buy it as a treasury asset. So, of course, they're going to be buying a lot more treasury bonds than Bitcoin. However, they're buying a smaller percentage of the treasury market than of the Bitcoin market, because the treasury market is a lot bigger than Bitcoin. So I think that the net effect, as long as Tether keeps buying Bitcoin, the net effect is going to be that it will likely pump Bitcoin and kill the dollar. God willing.
Interesting. Okay. Because, I mean, obviously there's a big difference between creating fresh structural demand for U.S. debt and simply moving existing demand for dollars onto faster rails, which is kind of what you're saying. I mean, which one do you think is actually happening?
I think it's both, almost certainly both. But I would just say that since some of that is displaced demand, so when we look at Tether and we say it's $180 billion new demand for treasuries, I don't think that's accurate. I think some number significantly smaller than 180 is likely the extra demand. So let's say it's $100 billion, give or take a few dozen billion dollars. So it's $100 billion. That's peanuts when you're talking about the U.S. government's insolvency. I mean, that's just that's a couple of weeks of the war in Iran. When you count in all of the costs, they're talking about $200 billion now, but they were talking about $100 billion for Iraq, and that ended up costing 100 times that. So expect something similar to happen here. There's going to be massive expenditure. There's going to be massive pressure on the dollar, and I think. I think the world is getting sick of the US, the world's getting sick of Trump, the world's getting sick of the dollar, and more people are likely going to be switching away from it to Bitcoin. But I also think even, from within the USDT world, I think USDT has introduced the new XAUT, which is a gold stablecoin. And I think that's going to start eating into the demand for USDT. I think a lot of people all over the world are going to realize gold is just a much better money than the dollar, and you'd rather not be financing the US government as it does all of these crazy, insane, criminal things around the world. So I think we'll see more demand for XAUT. We'll see more demand for Bitcoin in the coming years. And, whatever we cannot do as Bitcoin and gold marketers, don't worry, we've got the US government on our side destroying the dollar for us. We can count on them.
To this point, I mean, our time's going too fast, but in your newest book, you explore an alternative, kind of history where sound money prevents World War I. But, looking at modern warfare, if you take away the ability to print and lever money, does that really restrain a modern war? Or does the conflict just shift into sanctions, blockades, and financial coercion?
No, I think it's no coincidence that the century of total war was the century of central banking. And in the fiat standard and the gold standard, I focus a lot on this very pivotal moment in human history of 1914 specifically. That was the year in which the world went into World War I. And that was the year in which fiat money came into existence, really. That was when we went off the gold standard. Most people think of 1971. And in a sense, you could say that because there was still some kind of redemption of gold taking place until 1971. Central banks could redeem gold from the U.S. Federal Reserve up until 1971. But the real gold standard of the 19th century really ended in 1914 with World War I, and it was never really resumed in the same kind of shape and form that it took before World War One. And so that really was the turning point. And I think that was the most important thing about World War One. We'd had wars before, but this was the war in which all the belligerents had access to a money printer. And so previously, wars could only last for as long as the government had money. And the government had to take a hard look at its own treasury, which was, in the good old days, it was an actual physical room where piles of gold were sitting. So you'd look at that and you think about the war, and you think about the expenses of the war, and you think about your odds of winning, and you're very, very careful, because if you run out of gold in that big giant treasury room, it is game over for you. You're no longer king. Somebody else is going to come and take your throne, and foreigners might invade your country. So you need to really watch that. And the people who are reckless with their gold stashes in that kind of world, the people who act like they have a gold printer, are not going to be in the business of running countries for a long time. They're going to be wiped out by people who know how to manage cash balance without a money printer. But all of that is completely changed when you move to a world with fiat money, because now governments don't just have to. Now governments aren't restricted by the quantity of wealth that they have or the quantity of money that they have. They are restricted by the total quantity of wealth held by everybody holding on to their currency. They don't need to go to people and tell them, give us your money so that we can pay the soldiers. They just print money. They values the money in people's pockets. And people find themselves paying for the soldiers without wondering. And then this is really, for me, the most infuriating thing in the world, which is that, and it's sad. And the poor people the stupid people and poor people are being told constantly, it's not going to cost us anything. It's a good investment. It's a, war. It's important. Don't worry about the cost. There's all these, there are all these fallacies that are constantly being promoted about how government spending is good and government spending is basically costless. So when you think of these, most people just don't draw the connection between the fact that their grocery store is becoming more expensive and that their government is fighting a war. And it's just so tragic. I mean, if you ask probably Americans, what was the economic impact of the Iraq war? I don't think 20% of them would say inflation. Maybe I'm wrong, but I don't think a large number of Americans would say that this is what caused prices to rise. I think they don't draw the connection. They think prices rise because of evil, greedy capitalists or Republicans or deregulation or Democrats or regulations or whatever ideological thing you want to believe in. But really, it's war. It's money printing and it's war. It's war that's robbing you. And it's destructive and it's terrible. And if you had to actually pay upfront for the war, it would be very difficult. So currently, some estimates are that, let's say, that the Iran war was going to cost $200 billion. They're going to ask the Congress for that. First of all, that's a tiny fraction of the true cost, because a lot of the costs are not things that are going to require appropriations from Congress. They're just baked in. There's Medicaid and Social Security and all of these things that need to be paid for the soldiers, and all of the expenses that are part of the budget of the Department of Defense, and all the ammunition that's been run down, and all the bases that have been destroyed that are going to need rebuilding. All of these things, you have them $200 billion going to look like a rounding error by the time this thing is over.
Yeah.
But so let's say, if you lived in a world in which you had hard money, you couldn't move the troops anywhere. You couldn't start the bombing without having the cash ready, without having to pay them up front. So you'd need to collect the tax, you'd need to pay the soldiers, and you'd need to know that you have all of the money you need for the campaign. So we'd have none of this idiotic garbage that Trump is doing right now. It's, I don't know, maybe it's going to be 3-4 days, or maybe it'll be 30 days, or maybe they'll open Hormuz, or maybe they won't. Maybe we're going to destroy their power plant, or maybe we're having great negotiations with them. You'd have to be a grown-up, unlike this stupid clown, and you'd have to have a clear idea about what you want to do with the war. You have to think, all right, we have $400 billion, and that would allow us for 4 weeks. So here are our objectives of what we want to do in the 4 weeks, and here's how we're going to do it. And if things turn out in a different way, this is what our plan B is going to be. And you'd have to just very consciously and sanely manage your money. And that's just something that no government does today, because they're all ruined. Essentially, they're spoiled by the fact that they have a money printer. So that's why Trump can launch this war first and ask questions later. Same thing happened with Iraq. The war happens first, you ask questions later. The bill doesn't come. Imagine how different it would be if they had to specify, let's say, $400 billion is what we need. $400 billion is about $1,000 per capita in the US. There's a little bit more because there's about 350 million Americans. So let's say it's $1,000 per capita. Imagine you go around to Americans right now and say, everybody needs to pay me an extra $1,000 on their taxes this year because we want to bring democracy to Iran. We want to save Iranian women. We want to stop Iran's nuclear program. We want to help Israel steal more land and make sure that nobody in the region bothers them in any way. And we need you to cough up $1,000. Imagine going to a family of 5 in the US and telling them you have to pay $5,000 this year to fight the war in Iran. I mean, there's 350 million people in the US. That's a lot of people, a lot of money. A lot of them can't afford to pay that money. And only the absolutely most stupid and the absolutely most despicable and violent of them would be willing to pay for these kind of senseless wars that don't affect the US in any way, that which the US stands to gain absolutely nothing. If that's how they wanted to launch the war, they'd probably have maybe $5 million. If it was voluntary, if Americans had to actually foot the bill, who knows how much they'd have? 5 million, maybe 50 million? Wouldn't be enough to do any of this stuff. Wouldn't have been enough to do Iraq or Afghanistan or any of these stupid wars. But if somebody actually attacked the US, if Canada or Mexico or Germany or Britain or China got on aircraft carriers and wanted to attack the US, well, then it wouldn't be a problem for the US government to raise money to defend. Every American is going to want to put everything that they can, and they're going to want to fight, and they're going to want to use their own guns, and they're going to want to invest in anything that they can do to help, because they would realize then that there's a real threat and it's worth fighting for it. So it wouldn't be difficult to get funding for war that actually is viewed as legitimate by the population. It would be very difficult to get funding for essentially criminal mass murder, which is what the US government has been doing for the past several decades.
So, I mean, we can go into so many different places there, and our time is almost up. But I will ask you one more. I mean, if fiat doesn't make war free, I mean, it just delays and disguises the bill, then, we're talking about investors looking for it to show up in bond yields, currency weakness, commodity prices. I mean, even declining real purchasing power, as we've seen. Where does the monetary cost of war surface first in the real world? Where before the public fully recognizes it?
Yeah, it's a good question. I think, initially my focus was on oil prices. Yeah. I thought that would be the first thing. But I think, the way that Iran has managed to just completely take control of the strait and allow traffic to go through essentially uncontested, while all the aircraft carriers of the US are hundreds of miles away, unable to come anywhere near, suggests to me that maybe the oil shock might not be that big. Of course, this can change because, one U.S. attack on oil infrastructure in Iran means Iranian retaliation on Gulf oil infrastructure, and that could cause a massive crisis. But my dark horse pick for the most important place where this cost of the war is going to show up, fingers crossed, is in the 10-year bond, in the bond yields on the Treasury. I think that's what's really interesting. And it's really fascinating to see it, because a year ago was the last time Trump had, well, not the last time he's had many, but maybe his last very big stupid tantrum that he threw when he decided to impose all of these very idiotic tariffs on foreign countries. It was an incredibly idiotic thing to do for many, many reasons, which is beyond getting into right now. But the important point here is that Trump chickened out and backed out of his stupid tariffs exactly at the point where the 10-year yield came close to 4.5. I think it was when he hit 4.5 that he made that he walked back his tariff, and he gave a 90-day what was it, relief from tariff or something like that, and then basically the whole thing fizzled out, and essentially he was saved by the Supreme Court, which prevented him from doing this. I mean, it was an extremely expensive and stupid thing, but in any case, the important thing is that as the 10-year yield hit 4.5, he had to back down. And we had something very similar happen this weekend. The 10-year yield on Monday morning was nearing 4.5, And that was exactly when Trump chickened out and said, oh, we're making great progress in the negotiations with the Iranians, so I'm not going to destroy all of their power infrastructure and kill millions of people in starvation and disease. I'm not going to do this war crime that I very casually tweeted about a couple of days ago. We're going to give them another 5 days. Well, the 10-year yield went down then, but I think if there's going to be further escalation, I think the cost, I think the market realizes that all of these numbers, all of these numbers that are being given about the cost of the war are ridiculous nonsense. They're fiction. They are similar to the numbers that were given about the cost of Iraq. So anybody who's not a moron who watches TV constantly and believes what this government tells them is going to factor in that the cost is going to be a lot larger. They already got the Pentagon budget up to $1.5 trillion. They already need $200 billion for this. And, the way that the U.S. fights its wars, as has become very obvious now, is, the last 50 years, the Pentagon has innovated basically nothing except budget increases. How do we make everything so much more expensive? How do we make it so expensive so that our friends in the military industrial complex make a lot of money and then give us great jobs when we retire? That's basically been the Pentagon. While China, Russia, Iran, and other serious countries have spent the last 20 years building the hypersonic missiles and the drones that are the most important weapon of the 21st century, the U.S. was spending $10 trillion on fighting Israel's wars, murdering people so that Israel could steal more land, subsidizing Israel as it murders people in Gaza and as it sets up its torture gulag camps in Palestine. And that's just the reality of how the U.S. government has been operating. It's so ridiculously incompetent. It's absolutely astonishing. And that's why, China, Iran have hypersonic missiles and drones that are much more effective than what the U.S. has. And the U.S. is building these $14 billion monster aircraft carriers that are essentially obsolete. Here they are, they're fighting a war, and their stupid $14 billion aircraft carrier is in the Mediterranean, thousands of miles away. Why? Because it's dysfunctional. Why is it dysfunctional? Because it's an overpriced, stupid piece of junk whose only purpose is to make money for military industrial complex. Whatever the stupid aircraft carrier and these jets can achieve can be achieved a lot cheaper, a lot more reliably with a few drones. You can just have drones fly and achieve whatever it is that you want. This notion that there's all this that all of this technology in the U.S. is making it a military superpower, I think, is coming crashing down. And the U.S.'s ability to enforce its will on the world is likely being severely compromised. So all of that suggests the fiscal problem is getting more and more serious. I think, the burden of the debt is enormous. And as the yields go up, the impact is just going to go up. So, I've been waiting on this for many, many years. I think the implosion of the treasuries market is really Valhalla, as far as I'm concerned. It's if we can put government bonds out of business, that's going to be the best thing that we can do for humanity and for world peace. So I've been excited before, I've been burned before, but it's not going to stop me.
Not going to stop you.
Again.
Okay.
Yeah.
Well, listen, our time goes too fast. I'm not going to finish just up on that. I'll ask you one former, just kind of question, just on practical wealth protection in this environment, because former gold bug, of course, you're still long Bitcoin. We got a big audience that watches this. If a retail investor has some savings today, but they don't want to become a full macro speculator just to protect their purchasing power, what does a sane hard money allocation actually look like for them in practice?
It's difficult to give a one answer for everybody. As far as I'm concerned, it's really Bitcoin. That's it. Yeah. I think you want to have some fiat to cover expenses for a few months so that you don't have to be buying and selling with Bitcoin all the time, because the volatility can mean that essentially you're playing the lottery with the price that you get when you need to buy and sell if you have major expenses. So you want to keep some fraction of your wealth as an individual, or let's say as the operating cash for a business. You want to keep some fraction of that in fiat. You probably want some gold as a, depends on the level of conviction in Bitcoin. the higher your conviction in Bitcoin, the less gold you're going to need to sleep better at night. But beyond that, I don't really see a compelling case for investing in in other asset classes, except where you find a very clear, compelling advantage in the market where you have a very strong thesis and you're looking at balance sheets and you're doing due diligence and you've got a very clear idea about, let's say, well, AI is going to explode next year, so I want to buy NVIDIA or something like that. Like if you have these kind of theses where you're willing to put your money where your mouth is and you have a strong level of conviction and you have an understanding for it, then by all means go ahead with it. But I think you want to get rid of this melting ice cube in your hand that you need to get rid of. This idea that, oh my God, where am I going to put my money? What's going to happen to the S&P? Should I move my money from the S&P to the NASDAQ? Should I go from the NASDAQ to should I buy bonds? Should I do this? If you're stuck in this this cave of fiat assets, I don't have clear answers about how to navigate that. And I don't think that trying to navigate that actively will work out well. I think your best bet, if you insist on remaining in fiat assets, your best bet is to just buy the index.
Right.
But beyond that, I think, ultimately, as long as you're just able to build a significant base in Bitcoin over time, the risky thing about Bitcoin is if you go all in initially, there's enormous volatility. So you could buy the top and then witness a 70% drawdown, and that can be devastating. So you want to go in probably gradually, particularly if you're going in at a time when Bitcoin is hitting all-time highs, because it could be a top and it could be a big crash. So you don't want to be going in aggressively at a time when Bitcoin is near all-time highs. You want to be gradually going in and then gradually building your position, increasing the size of your position until the position is essentially comfortable for you to be able to have a very large position there, so that even if it were to draw down 70%, you're fine because you've got other assets, you've got fiat to manage your expenses, and you don't need to be selling the Bitcoin during these big drawdowns.
All right, that's Saifedean Amos, author of The Gold Standard, the Fiat Standard, and the Bitcoin Standard. Great book, that last one of yours.
Thank you. I'm glad you liked it. I mean, it's still a bit of a Bitcoin book, but it is also a gold bug book. So for all of the gold bugs out there, I mean, let me just do a little bit of an advertisement for it. It's an alternative history of the 20th century where fiat money dies in 1915. Yeah. So we were talking earlier about war. This is a thought experiment of what happens if we'd had a clearing mechanism that allowed people to settle gold. Remember the first question that we discussed in this interview, that ultimately the limitation of gold is that it's difficult to have a market where it clears and it can be used as money. Well, in this book, I introduce an airplane-based settlement network in gold in 1915. Well, it starts in 1911, but it's taken off, if you'll excuse the pun, by 1915. And that results in the collapse of all of the major central banks of the world in 1915, because people take their money out of the banks that are financing the war and they start trading with one another directly. So we have essentially a peer-to-peer distributed network for trading gold. And that means nobody needs to keep their gold at the central bank. With a lot less gold in the central bank's Ponzi's collapse. And then the war ends in 1915. So then we go back on a gold standard, but it's a lot better gold standard than the one that we had in the 19th century. It's an industrial, technologically advanced gold standard. So the whole book is trying to imagine what the gold standard could have looked like with 20th century technology, and what the 20th century could have looked like if we had had the gold standard instead of fiat standard. Spoiler alert, a lot more prosperity and a lot more peace and a lot less war and a lot more technological advancement.
History repeats itself. It feels like always a sharp, serious conversation that forces us to rethink the mechanics of money. Appreciate your time. Thanks again for joining us today on Kitco.
Thank you so much for having me. It's a pleasure.
All right. And a big thanks to our sponsor, Swan Bitcoin, your partner for generational wealth. You can get started at swan.com/Kitco. And thank you for tuning in. If you want to stay ahead of the macro trends and get independent, hard-thinking analysis you won't find on mainstream networks, make sure to hit that subscribe button right now. I'm Jeremy Saffron. Thanks for watching. I'll see you next time.
Swan is the premier Bitcoin wealth platform serving leaders of families and businesses. Swan's mission-driven team simplifies Bitcoin investment, custody, and security, bringing you concierge service, world-class research, and exclusive events.
Introducing the Ultimate Precious Metals IRA, handbook your map to the great monetary re-architecture. We have left institutional assumption behind and entered syntactical trust where code, math, and physics replace brand promises. Become a sovereign node and let the robot referee enforce value with 12-second finality. No lawsuits, just execution or instant reversion. Anchor wealth on the 3 pillars: rules, rails, and rock, with legal claims, tokenized rails decentralized, and gold and silver as the immovable core. Upgrade from hoarding to kinetic metal with spendable goldbacks and silverbacks divisible and collateralizable so you can use them without triggering a sale. Use financial teleportation to spend purchasing power without selling with ERC 3643 compliance and atomic reversion guarding your principal. Stack more ounces through the gold-to-silver ratio play and bypass rigged retail premiums with institutional-grade acquisition inside the financial biodome. Claim your sovereign position. Now get the handbook qualify as a Lex node operator and call 888-524-3648 or 904-892-7870 before the window closes.
I wanted spending money that didn't lose value the second That's why I started using goldbacks. They're real 24-karat gold you can spend just like cash, but with one huge difference. They don't get crushed by inflation. Thousands of stores accept them, so I can actually use them for everyday things. And while my dollars weaken sitting in my wallet, my goldbacks hold their strength. Plus, when you pay with them, nothing gets tracked. It just feels like cash finally upgraded into something that protects you